Russia cuts interest rate again amid economic slowdown. In a significant move that reflects the current economic climate, Russia's central bank has once again decided to reduce its key interest rate, marking the second consecutive meeting where this action has taken place. This decision comes amidst growing evidence of a pronounced slowdown in economic activity, a stark contrast to the rapid growth experienced over the past 2 years, which was largely fueled by government expenditures related to the ongoing conflict in Ukraine. On Friday, the Bank of Russia announced a reduction of its key interest rate from 20% to 18%. This adjustment follows an earlier cut made in early June, which was the first decrease since 2022. Notably, this latest move aligns with what many investors had anticipated, indicating a broader consensus about the need for monetary easing in response to the economic challenges ahead. But here's where it's controversial. Some analysts argue that these rate cuts may not be sufficient to stimulate the economy effectively. With inflationary pressures still looming and consumer confidence wavering, the question arises, can lowering interest rates truly revive an economy that seems to be faltering? As we delve deeper into this topic, it's essential to consider the implications of such monetary policy changes. For instance, lower interest rates can make borrowing cheaper, potentially encouraging businesses and consumers to spend more. However, if the underlying economic issues are not addressed, such measures might only provide temporary relief. What do you think? Are these interest rate cuts a wise strategy for Russia's economy, or do you believe they could lead to further complications down the line? Share your thoughts in the comments below. Russia's economic crisis. Will the Bank of Russia cut key interest rates? Warning signs flash. Can Russia's economy avoid recession with a bold interest rate move? Imagine a scenario where the world's 11th largest economy teeters on the brink of recession. Welcome to Russia's current economic landscape. Amidst slowing inflation and mounting pressure from both officials and the business community, the Bank of Russia is poised to make a crucial decision that could either stabilize the economy or send it into a downward spiral. The stage is set for a key rate cut, but how deep will it go? As the Bank of Russia prepares to announce its benchmark interest rate decision this Friday, all eyes are on the potential for the second consecutive cut. A unanimous consensus among economists surveyed by Bloomberg points to a rate reduction, with a significant majority, 6 out of 10, anticipating a substantial 200 basis point cut to 18%. However, the plot thickens, with one analyst boldly forecasting an even more drastic decrease, while 3 others predict a more modest cut of 100 or 150 basis points. But here's where it gets controversial. The question on everyone's mind. Will the Bank of Russia opt for a cautious approach to avoid shocking the market, or will it take a more aggressive stance to preempt a recession? This dilemma sparks a broader debate. Can deep interest rate cuts truly shield an economy from recession, or are they merely a temporary palliative? And this is the part most people miss. The outcome of this decision will not only impact Russia's economic trajectory, but also serve as a case study for global economists grappling with the challenges of balancing inflation control with recession prevention. As the world watches Russia's next move, a pressing question emerges. What are the long-term implications of relying heavily on interest rate adjustments to navigate economic turmoil? We want to hear from you. Do you believe a deep key rate cut is Russia's best bet against recession, or is it a risky gamble? Should central banks prioritize inflation control or economic growth in times of uncertainty? Share your thoughts in the comments below, and let's spark a discussion on the future of economic policymaking.